Hi everyone, this is Charandeep Kapoor. Welcome to our part 2 of a video series on options analytics. In the past video, we discussed about the options open interest. The option open interest in that video gave us a sense of market direction and we were able to judge what trades the hedge funds and the institutional traders are taking based on the options open interest, which we can see here. So if you want to check out that video, you can click on the I button, and in that video we judge the market. Try to judge the market direction based on the trades which the institutional traders and larger traders had taken. If you want to check out that video, you'll find it in the I button. And as discussed in that video, to reach the options analytics, you have to click on the resources drop down on the option chain page. In this video, after we have decided the market direction, we'll discuss what type of trading strategy is best for that market direction. For example, let's say that you are bullish. What is the best strategy to take? Is it buying a call option? Is it buying a future? Or is it selling a put option? To answer that question, you need to look at the implied volatility and the realized volatility. So this is the chart of IV minus RV. As you can, and this is the chart for Ethereum. As you can see, the green line, which is the realized volatility, is higher than the red line for most of the time, which is the implied volatility. The realized volatility is the volatility which has actually played out in the market, and the implied volatility is the trader's future prediction about what the volatility will play out to be. As you can see, the realized volatility of Ethereum peaked at around 100%, and for Bitcoin, it peaked at around 80%. Now, what does that mean? That means that if the realized volatility was higher than the implied volatility, it means that the actual movement which played out in the market was more than what the options were pricing in. A simple example of this can be if you were to take the straddle pricing for 1 week, that will give you what the traders are expecting the move to be. For example, if the straddle pricing for Bitcoin is $1,000 for 1 week, just as an example, it means that the traders are expecting Bitcoin to move between plus 1,000 and minus 1,000 from the current spot price. If the traders are expecting a bigger move, they should buy the straddle and create a long straddle strategy. And if the traders are expecting a Bitcoin to move less than 1,000 points either side, they should take a short straddle. Now, if more and more people take the long straddle, the prices of the long straddle will continue to increase. That is why we are saying that the implied, so that also means that the implied volatility will continue to increase. And same way, if more and more people want to sell these options and sell them cheaply, the price of this straddle will decrease. And this continues for all straddles to all strangles for every strike price. So if people are expecting a sideways market, or if people are expecting not much movement in the market, the options will be priced cheaply because people will prefer to sell them and not prefer to buy them. And also, if the people are expecting a higher move, similarly the options will be priced higher. As we can see from this chart, the realized volatility is still higher than the implied volatility. It means that the options are being sold heavily and people are preferring to sell them at cheap rates rather than buy them. So it will be a good trade to take to uh, to take a contrarian view of this. So, since the realized volatility is higher, it is a good strategy now to take a debit strategy or to buy options because these options are very cheap. So, in the previous video, we discussed that the market view is a bit bearish. So, what you can do for this? So, rather than selling a call option, you should prefer to buy a put option. Another trade which you can take based on this same idea is to take put debit strategies, that is a bear put spread, that is buying a ATM or a OTM put option and selling a further OTM put option, which will reduce your debit. Also, this is the chart for IV minus RV, which also shows us same what is shown above, that the implied volatility is lesser than the realized volatility. And whenever this happens, you should go for debit strategies and you should go for buying options. And whenever it is the reverse, that is the implied volatility is higher than the volatility which actually plays out in the market, that means the options are priced higher. So you should prefer to sell them. Also, this is the chart of the implied volatility versus strike, and this is usually a smile curve. This is distorted. This is distorted heavily towards the puts. As you can see that the implied volatility of the puts are higher than the calls. Why is that? Because people are buying these options and they are selling calls, which also indicates the bearish market.